but you need to make two decisions almost. One is as the director of the limited company, so is this the right thing for the company? But then secondly, is this right for you as the individual as well?
If you're a director of a limited company which is experiencing financial difficulties, it may be a good idea to continue watching this video. I'm Sean Barton, partner at Real Business Rescue, and in this video I'm joined by Dave Broadbent, one of our licensed insolvency practitioners. And together we're going to look at some of the answers to the most common and most important questions we get from small business owners. From all the warning signs of impending insolvency, understanding your options for liquidating or restructuring your company, through to dealing with HMRC and the risk of being held liable for company debts, this video will cover it all. So welcome, Dave. Tell me a bit about yourself, Dave.
Morning, Sean. Dave Broadbent, partner in the practice, licensed insolvency practitioner. Been doing the job for nearly 30 years now.
Wow.
Current R3 Chair of Yorkshire as well. So that's a governing body I've been involved with for most of the 30 years that I've been within the industry. Specialisms, I specialise in owner-managed businesses. So I'm lucky enough to have created, traded for a period of time and then successfully sold my own business. So not only am I able to bring to the table the fact of the skills that I've got through the 20 odd years, 30 years of doing the insolvency, but also I've been there as a business person as well. I understand the pressures that directors are under as regards trying to find the money to pay the wages at the end of the month, making sure that your accounts are in, making sure that all of that sort of side of it is done as well. As much as I'm an insolvency practitioner, I like to think of myself as a problem solver. People come to me with their issues, and I like to think I come up with some decent solutions for them.
Thank you, Dave. Let's start simple. What is insolvency, and how would a director know when their business is actually insolvent?
The main sort of cause of insolvency that people will have is the fact that their business is unable to pay its debts when they fall due.
Okay.
A key trigger for that would be pressure.
Right.
So people are seeing payments getting bounced, if they are struggling for money, if their accountant has produced a set of accounts and they are insolvent, so in other words, there's not enough money to actually pay their debts, then they are also insolvent at that point. But the main trigger is generally when people are running out of cash.
Running out of cash, okay. What stops people talking to us in the first place, do you think?
I suppose there's a number of things, to be honest. Having done this job for nearly 30 years, you tend to find there's a lot of embarrassment. You know, people don't want to fail at what they're doing. I used to run my own business prior to becoming a partner in the firm, and it's difficult. You know, it's really difficult. And to actually hold your hand up and say that you need some help is a big ask. So there's an element of embarrassment there. I think there's also uncertainty. I think people are concerned about what's going to happen to them.
Sure.
Social media is a brilliant thing, but it can also be the bane of our lives. And unfortunately, there'll be horror stories on there of people concerned that they may get disqualified as directors, may lose their home, have to pay money into it. So yeah, it's uncertainty, I think, is the main word.
Got you. So let's just go down the road. Someone's speaking with yourself and you realise they are insolvent. What are the options? What do you discuss?
I think that the distinction we need to make really is because more often than not, people are coming to see us, the directors of a limited company. So we need to distinguish the fact that you've got a business that trades within the limited company.
Yeah.
Okay. So the first thing that we need to look at is the business viable or not?
Right.
That'll involve bringing their accountant on board, perhaps bringing other parties involved to have a good look at that. Once that decision's been made and you decided whether the business can carry on or not, the next question is it to be done through that limited company or not? I know we're going to go through the options in a bit more detail in a bit, but that's the fundamentals really. One, is the business viable? Two, is the company viable as well?
So you hear a lot about liquidations. What is a liquidation?
So liquidation is basically a precursor to dissolution.
Right.
So a limited company is basically an entity that's created for a project, a format. So it could be it's acting as a vehicle for a business. It could be that it's a vehicle for a construction project, something along those lines.
Yeah.
And when that project comes to an end, either because it's unfortunately failed or it's successfully gone through, we need to deal with the company.
Right.
If the company has no assets or liabilities, it can be simply dissolved. If the company is unfortunately insolvent, like we said before, there's not enough assets to pay everybody off, then it should really go through a liquidation procedure. That's not to say that it has to go through a liquidation procedure, but a liquidation is basically a way in which somebody will put to bed the company as the precursor to dissolution.
So you hear it, don't you? Well, I don't want to liquidate my company because I'll just let HMRC liquidate. What would that involve? Is it compulsory liquidation?
Yes, good point. So if we were having this discussion probably 10, 15 years ago, I would say there was a high chance that somebody like the Revenue would issue a compulsory winding up petition against the company.
Is that more risky?
A little bit. I think again we come back to this certainty word. So when a company is placed into compulsory liquidation, it's like a bankruptcy of the company.
Right.
It's essentially where a creditor has taken it upon themselves to apply to court for the company to be placed into liquidation. So the company is still in the same position, whether it goes for a voluntary liquidation or a compulsory. The difference is who's actually dealing with it. In the initial stages on a compulsory liquidation, it's the government, so it's the official receiver that deals with it.
Mm-hmm.
That official receiver may then choose to bring in a third party. Now, some compulsory liquidation appointments are done through what's known as the rota, and the downside with the rota is that it's a lottery to whom you get.
Gotcha.
So if you aren't comfortable with the liquidator that's been chosen, it's tough. And that liquidator could be somebody who'd be perhaps a little more aggressive than somebody who your professional has introduced, or somebody that you've already got a bit of a relationship with.
So the big warning signs is a winding up petition. What should someone do if they receive a winding up petition on their doorstep?
Take advice, Sean. Take advice. I think winding up petition is generally where a creditor has had enough.
Right.
Doing nothing just won't help.
Yeah.
Sometimes, being honest, you don't have to do anything. If compulsory liquidation is potentially the better option, then you can allow that to happen. But I think the first thing to do is to take the advice, because ultimately, not everybody has gone through this procedure themselves before. You know, what you want is to speak to a professional, somebody who's with a lot of experience, who will say, if you allow it to go into compulsory liquidation, this is what will happen.
Yeah.
However, we could still pull it back from the edge by perhaps looking at a voluntary liquidation procedure. Because sometimes the Revenue and Customs, when they issue petitions, they've had enough. You're not going to negotiate with them at that point. But if the director chooses to switch routes to a voluntary liquidation, they may still be able to take back control. And I think that's the key word here, Sean, to be honest, is control. When it's in a compulsory liquidation, you do not have control. Voluntary liquidation, you are in control.
So let's talk about HMRC. They're probably one of the most aggressive creditors, aren't they? So are you seeing a lot of this activity now with HMRC?
Absolutely, yeah. Again, if we were having this conversation 3-4 years ago, I'd say no. As much as the Revenue and Customs say they're not under a remit to do as the government sees, in the first, for 2020, 21, possibly into 22, I think there was a signal there to say that they weren't supposed to go gung-ho in recovering this money. You know, a lot of people were trying to recover from what had happened during COVID, and I think the Revenue and Customs kind of took the foot off the accelerator, the collection accelerator a bit there. Now, completely different. What they are doing, they have ramped up in particular what's known as field officers.
Right.
So a field officer is essentially a government official acting on behalf of the Revenue and Customs, who will attend a company premises for the sole purpose of collecting the money in. They do not care about any other creditors that the company has. They do not care how many staff the company has or whatever. They are basically there to try and collect the money back from the Revenue and Customs. So yeah, the Revenue is certainly getting a lot more aggressive. We are now starting to see a lot more compulsory liquidation petitions out there. And what we're also seeing as well is what we call a bond request.
Okay.
So when a company in particular has a VAT debt that it hasn't paid, one route that the government can do is to serve notice on the director personally. And this notice basically says, we have concerns as regards your ability to maintain your VAT repayments. If we are therefore going to ask you to make a deposit payment, that deposit payment could be tens of thousands of pounds. And basically, if that payment isn't made within a certain period of time, they withdraw the VAT registration status. And when that happens, if the company continues to trade at that point, it's a criminal activity. And that's the focus really for the directors. I can give you a classic example of a gentleman that came to see us yesterday who had exactly that thing served on them. Really? He owed the company £50,000-60,000 of VAT. Instead of them going down the compulsory route, they served this notice on him. And it had the desired effect.
You're seeing that more and more now?
Absolutely.
Really?
Absolutely, Sean.
Okay. What about time to pays? Are you seeing a lot of those? Getting a lot of requests for time to pays?
Yeah. I mean, we've got within the firm a specialist department that will actually assist directors with the time to pay arrangements. Just so everybody's aware, time to pay arrangement is basically a sort of an informal repayment plan with the Revenue and Customs, whereby they will allow you to pay an element of debt for up to 2 years. The period of time that they'll actually allow you will be dependent on how comfortable they are with you as a business owner. So if they have concerns that you haven't been paying your VAT for some time, you may find that you can only get a 12-month or possibly even 6 month time to pay arrangement. But if it's something that perhaps isn't your fault, maybe it's a bad debt, change in the economic circumstances, something like that, then they may allow you up to 2 years. Couple of things to take on board there. One is that you do have to have rigid compliance. There is absolutely no point in trying to ask for a time to pay arrangement if you've not filed a VAT return for the last 3 or 4 quarters. Secondly, is the arrangement itself is based upon the fact that you will continue to make the payments of the time to pay arrangement, but also would make sure that you pay your future tax debts when they fall due as well. There's unfortunately a number of traps that directors will fall into, where they will agree, they'll panic, they'll agree a time to pay arrangement, which the only way in which they can afford to do it is by paying the Revenue and Customs time to pay with their future VAT payments. And we've had a number of instances where time to pay arrangements have been pulled. So I think again the key thing there is, before you agree to a time to pay arrangement, take advice. Take advice from the accountant, an insolvency practitioner, somebody who will help you put together something, an offer that you can adhere to and you will be able to meet.
So let's just say all those options you've tried, you can't get through a time to pay. We're now at liquidation. Talk me through what a liquidation is.
Okay, so liquidation, first of all, is, as we mentioned, it's a precursor to the dissolution of the company. So first and foremost, the business itself has to have ceased trading, or at the point that we're generally instructed, that's when the actual closure will take place. So a lot of the work that we're dealing with at the moment involves online businesses. So owner-managed businesses, what we call personal service companies, individuals, sole directors within a limited company. So a lot of the liquidation work that we're doing is through the internet. Incredibly straightforward now. Again, as I mentioned earlier, I've been doing this job nearly 30 years. I remember back in the day, not long there, I don't look it. It's, back in the day, there would be meetings of creditors, formal meetings that process lots of paperwork involved. The government, luckily, have taken the decision to make the route much more streamlined. So we can now do everything over the internet. So where our team is based, we are helping companies up and down the country. Everything is done over the internet. Okay.
How long would it take to do liquidation?
So the project from my team takes somewhere between 6 and 9 months for a very, very basic liquidation. From the director's perspective, it really is just the first couple of weeks. The team at RBR are fantastic at helping with populating the portal. So the portal is the online database system where the director puts the information on there that we need to produce the paperwork. So once the director's done that, that could be done in an evening, perhaps 2 evenings with the guidance from your team. Once that's been done, it generally takes us a couple of days to put together the paperwork. There are statutory periods that we need to set, but you can generally have a company into liquidation within 3 to 4 weeks. The one thing I would say though is, even though you've got that time delay, the minute that we're instructed, we start speaking to people. So if the revenue have turned up on the doorstep, if there is a county court judgment, bailiff looking at recovering assets, or just general phone calls from creditors, we can get involved straight away on that.
So if it's not a liquidation, it's not that bad, and what other options are there?
Yeah, it's a good question. So again, coming back to the point I mentioned earlier, so we have, is the business viable and is the company itself viable? So we've got two different outlets. Let's say, for instance, the business is viable,
Yeah.
but the company isn't. Okay, so in that instance, there's two different alternatives we can look at. We can either, if the company itself is just about keeping its head above water, so it's managing to pay its debts when they fall due, but it literally doesn't have any surplus income left over, we can look at a rescue of the business as a going concern. So as I mentioned, the company's too far gone, so therefore we get the accountant to assist with the creation of a new limited company, and the business is then transferred across.
Gotcha.
Everything is done above water, above board, should I say. We have independent agents that value the business as well. The director's report that's circulated gives full disclosure as well. But what it does is it just allows the business to be transferred across, and those employee claims, jobs to be saved. The second alternative we've got is if we are in a position where perhaps the company is too far gone, it's too insolvent, but it is in a position to make monthly contribution payments, then we could propose what's known as a voluntary arrangement.
Okay.
So a voluntary arrangement is, in its basic terms, a formalised repayment plan with creditors. So more often than not, what we won't do is we won't look at the debt, the amount of debt the company's got. What we'll look at is how much can that company afford to pay, first of all. What we'll then do is we'll work with, because we've got a couple of specialised teams within the firm that will be able to do this, they'll then process the monetary part of it. So in other words, this is how much a company can afford, can pay it over 5 years, take into account the costs involved, the number of creditors, this is going to be the outcome for creditors. Our teams are then have the knowledge of the different types of creditors to see what specific returns they would expect. But just to give you an example, CVAs, as the known company voluntary arrangements, you could look at returns of 30% to creditors, but they will accept that over 5 years on the basis that the alternative means getting nothing under liquidation.
So I guess that comes back to the question about what you discussed. You're looking for the right option for that business, aren't you?
Absolutely right, Sean. And that's why I think it's getting that clear, concise advice. The number of times where I'm speaking to a director who's had a conversation with a third party, and the first question you ask is, well, what did he discuss? Well, he mentioned this and he mentioned that, but I wasn't really fully understanding. You know, what I'd like to be proud to say is that myself and members of the team, whenever we're advising directors, they come away from that conversation fully aware and understanding those different routes. What we do is we generally back it up with a letter of engagement, which goes through the different alternatives we've spoken about. Because again, more often than not, it's not just one option you've got. You know, there could be a couple of different options. What you need to do is to do a bit of homework to be able to decide which is the better option. You can then present them to the director. He or she can then decide which is the more appropriate to them.
Thank you, Dave. So, Dave, someone is insolvent and they're looking to do a CVL. What advice would you give them before they enter into a formal process? Okay,
good question, Sean. So, when I'm speaking to a director, because obviously at that point they're not going to make an immediate decision.
Yeah.
They may want to consider the options, perhaps trade on for a period of time. We call this period almost like the twilight period between when they've first spoken to us and when they actually, whatever it is that happens, whether they close or whether they look at a sale as a going concern. First thing that we always say is your best port of call is probably to not enter into any major contracts as you can. So perhaps If it's a customer that comes to you and says, look, I'd like to start working on a contract, can you give us a deposit? No. Or if you are, make sure that those funds are segregated away. Try not to make any material payments to anybody at that moment in time as well. If anything, just keep the plate spinning, and just allow everything to essentially settle while you're making that decision. More often than not, directors will ask the question of, how long can I keep going? Now, what I always say to them is two things, really. One, we've spoken about wrongful trading already.
Yeah.
You've been told by an insolvency practitioner your company's insolvent. Therefore, if you make losses, if you carry them for a couple of weeks, it's not a problem. 3 months, 6 months, the problem is that conversation is going to come back and bite you at a later stage. But secondly, I always say, if you've ultimately made that decision at that point, then there is probably no reason to not press on. If anything, delaying it, there is within one of the sort of the statutory obligations is delaying tactics.
Okay.
And the last thing that you want to be doing is stringing people along. Because if you're under pressure from creditors, if you've ultimately made that decision that you're going to liquidate the company, it's better to get on with it than allow that to carry on, because all that you're going to potentially do is open yourself to criticism from them at a later stage.
So if I'm a director and I've got a lot of debt, and let's just say I've got 10 creditors, how do I know who to pay and when to pay? What happens?
Absolutely, it's a good question. It's one of a common question we get asked by directors. Who should I pay? The answer is nobody, because if we select and pay a creditor in preference to other creditors, it's known as Section 239 of the Insolvency Act, we could be held personally liable for it. So a classic example would be, the director approaches me, he's got a limited company, he knows he's probably going to have to liquidate that company,
Yeah.
but he's looking at creating a new limited company and perhaps transferring across a contract. What he may say is, I really need to pay this supplier, because if I don't pay the supplier, it's not going to help me in my new company. The problem is that is a nailed on preference. So my advice always to the director is, it's your choice ultimately at the end of the day as to whether you make the payment or not. But if you make the payment using the company's money, then you need to be aware there's a high chance that you will have to personally repay that money back. So ultimately you're going into it with your eyes open wide. In a rough and ready, if using your example, we've got 10 creditors, those 10 creditors are owed £1 million and we've got £10,000, we should chop that £10,000 up and pay everybody a proportion depending on how much they're owed. If we deviate away from that, we can be held personally liable for whatever other people have lost out with.
And what if I'm holding assets as a director within the company, Dave? What's the process? What should I do?
Again, another very good question, and one that we always get asked, because we were talking before about the transferring of the business and assets across. I always parachute in an independent agent, somebody who's got no relationship with the company, and will look at it with a blank sheet of paper. So he will provide his thoughts as to what that value is. If we choose, say for instance, I've had situations where a director has got 2 lads, worked with him for a long time, they've been flying around in the vans, and he basically says, Sid and Tom, I'm just going to let them have those vans. First thing I'll say to them is, you can't really do that, because if you're doing it, you're transferring those assets at an undervalue. So effectively, those third parties are getting the benefit for no cash.
Right.
Again, it comes back to personal liability. So it's your choice, director. If you want to transfer those assets at an undervalue, away you go. But there will be a conversation held, because if we don't parachute an agent in now, I'll be parachuting an agent in later on who'll be giving me an indication anyway. Being honest, 99.9% of the time, directors take that on board. They don't do the preference payments and they don't do the transfers at an undervalue. But what it is managing their expectations and making sure they have that clear advice, such that they don't do something and then 3 months down the line, they suddenly get a letter from a solicitor saying, by the way, you transferred X, Y, and Z, you paid off of these people, you're going to have to now personally contribute.
So take advice early.
Absolutely.
Brilliant. Another really personal question that I can guarantee we get asked on nearly every call is, how will a credit voluntary liquidation affect me? Will it affect my credit score? All those type of questions.
Absolutely.
Can you demystify that for us?
Yeah. So, is this going to affect my credit rating? First thing first, director, limited company, two separate legal entities. So the fact the company is going into liquidation should not affect the credit rating of that director.
Right.
The only time that there will be ever an impact is where you've got a crossover. So it's either a personal guarantee or perhaps an overdrawn loan account. That generally doesn't affect their personal financial circumstances.
Dave, let's talk about cost. So someone comes to you and wants to do a CDL. How do you price that business up, and how does directors pay?
Yeah, okay. So very good question again. So it will depend upon the amount of work that's required to be undertaken. We have a standard fee that we charge for a very basic liquidation that we do. Most of the liquidations are generally funded by the company. So the company's assets will be realised. Either there might be money in the bank account, or there could be customers that owe them, or there could be physical assets that we arrange to be sold. And those funds then are used to meet the cost of the liquidation procedure. The company itself doesn't have any assets.
Sure.
The director still needs our assistance to liquidate the company, but the company can't pay. The director still wants us to do it, so he or she would have to personally meet those costs.
So let's move to the current time, really, Dave. How are you finding the insolvency market at the moment?
Busy at the moment, Sean. To be honest, we're doing collectively, we're doing a huge amount through the internet at the moment. The fact that the liquidation procedure has been a lot more streamlined, it's made it much easier for directors. There's a lot more people coming to the front and saying, just unfortunately needs to be put to bed, so to speak. There's a lot of concern out there at the moment. We've got obviously high interest, we've got high costs, living costs at the moment.
That's what you're hearing when you're speaking to directors every day.
Exactly, yeah, exactly. And we're getting what I call the shrinkage effect. So this, as I see, first happened in 2008. Where we had the banking crisis that first took place there. What you are finding is if you can imagine the sector of whatever industry you work in is a big piece of cake. What's happening is that is just getting smaller and smaller. There isn't that much to go around. So if you take, for instance, the construction industry, what you will find now is that some of the big boys will start delving down into the mid-tier. They'll be offering quotes for work which will be often cost less, 10%. Because it's better for them to have the lads working than it would be for them not, and not getting any income in whatsoever. So construction is struggling as a result. Retail, again, hospitality. So this all comes back to Joe and Jane Public, because ultimately I think we're all agree that things cost a bit more now. You know, you do your shopping at Tesco or whoever it is, you come away with not much change from £100. Whereas so many years ago, you might have got a bit more for it. Utility bills are going up as well. So everybody's getting the squeeze, and what they're not doing is spending as much. Finding a lot of the holiday sector as well. They seem to be struggling. There was a gentleman that I helped out about 9 months ago, and what he said is that during COVID, obviously we couldn't go anywhere. Came out of COVID, and everybody was desperate to go on holiday. So they artificially ramped up the prices. They kept them at that level for a period of time, and then suddenly people can't afford to do it. So irrespective of how low they're dropping at the moment, people are not doing it. Because what you'll find is, perhaps instead of going abroad, they might go for a weekend. So maybe go camping or do something that's not going to cost as much. So all of that has an impact on the businesses that previously have been enjoying quite a decent level of turnover. But yeah, construction, retail, hospitality, those are the major sectors at the moment that we're seeing.
How much do you think the budget has contributed to insolvency?
Yeah, very good question, Sean, very good question. So I think a couple of things there really. One is the increase in national insurance contributions on employees.
Yeah.
So again, if you can imagine a small business, a lot of small businesses that I'm speaking to at the moment, 4 or 5 staff members, they've just added an extra level of cost on there that they cannot transfer onto the customer.
Sure.
The issue then is they have to look to the staff members and say, the only way in which I can deal with this is either getting everybody to take a collective pay cut, or somebody's going to have to lose their job. The problem is the redundancy cost, because they've had a very loyal workforce that have been with them for 15 years, getting rid of one of the staff members is going to cost them an absolute fortune. So we've had to do a couple of restructuring processes for that very reason, just simply because of the increase in those national insurance contributions.
And have you noticed that's affected different sectors in different ways?
Definitely, yeah, definitely. Hospitality in particular as well.
Right.
Because I think the other aspect that came out is the increase in minimum wage.
Mm-hmm.
If you look at what is now £21,000, I think, something along those lines. So what you've got is this knock-on effect that we're seeing in businesses, whereby the junior members who were getting paid a certain amount suddenly got this massive uplift to £21,000. The middle managers, the sort of junior managers, seeing those uplifts, they want an increase themselves, the senior managers, and you have this knock-on effect that works its way through a business. Hospitality in particular is a lot of low-level employments with a couple of managements within there. So as soon as they ramped up all of the minimum wage, it made a huge amount of them basically unviable overnight. We are still seeing, it's bizarre, you'll go down the street, you will still see restaurants very full. But when you scratch the surface and actually start looking at the books, a lot of them are loss-making. They've also got business rates to take into account, high levels of rent that they're having to pay, and utilities shooting through the roof as well. We're still seeing quite a few instances where pubs in particular, restaurants, entered into contracts whereby it was a fixed term.
Sure.
And the problem is they cannot get out of that fixed term now. Yeah. And the problem is it's costing them too much as a result.
So in terms of the type of directors you're speaking with at the moment, Dave, are you speaking to, one man in a van, or are you speaking to SMEs? What's the mix?
I'd probably say the majority is small owner-managed businesses. So an individual, perhaps they may have one employee, but generally just that person. I think it's becoming more and more difficult to be a business owner at that level,
right?
Just because of the amount of legislation, accounting legislation that you have to go through, pressures that are involved on them, coming back to that shrinkage effect that I was talking about as well, and also funding. I think funding at the moment has probably become the most difficult that it has in quite a while, actually. Most limited companies now, if they wanted to actually borrow, would generally have to borrow A, at a high interest rate, and B, give a personal guarantee as well. I had a meeting last week with a gentleman who owed a chunk of money to the Revenue and Customs, been in business a long time. Unfortunately, just circumstances beyond his control had put him in this position. He was due to go out to the marketplace and borrow the money to put in to basically displace the Revenue and Customs debt. My conversation with him was, it's incredibly honourable what you're talking about doing, but you need to make two decisions almost. One is as the director of the limited company, so is this the right thing for the company? But then secondly, is this right for you as the individual as well? Because ultimately, from your perspective, one, you're giving yourself a massive personal guarantee that you're going to take. Yeah. Two, you're going to have to make a huge amount of profit before you see anything back on that investment. And you are then always going to be the person at risk as a result. So yeah, I think I do feel for a lot of the smaller businesses at the moment, and those are the guys that we're seeing. It's not going to be long though, Sean, being honest with you, until we start seeing the bigger boys struggling as well at the same time.
So that said, there's going to be a lot of worried directors out there that are watching this video that may not want to phone up. What would be your big piece of advice to those directors?
Again, I think it comes back to what we were chatting at the outset. There is obviously a lot of embarrassment in relation to it. There's a lot of concern and fear of what's going to happen as a result. Two things really. One is, what have you got to lose? From having a conversation with somebody, they could make you feel a bit better actually, if any, just to ratify where you think you are, but it might not be as bad as what you thought. And then secondly as well is, it's what's the alternative? Instead of picking the phone up to somebody, carrying on, potentially getting in a worse position, it's if you had an ailment, a physical ailment, you may allow it to go for a short period of time, but you generally go and see the doctor. Even if the doctor was just going to simply say to you, it's fine, it's a rash, it will go. But if it's something more serious, you'd want to know. And that, I think, comes back to what we do. It's just about getting that information, going through the alternatives, and more often than not, you'll generally find that it's perhaps not as bad as what they thought.
Brilliant. Thanks for answering all the questions, Dave. It's been a pleasure.
No problem.
Thank you
too.
very much.
Cheers, Sean.
So a big thank you to Dave for joining me today. We do hope you found this video useful. If you would like to speak to myself or a member of the team about your company, we are always here to help. So get in touch with us and we can provide you with the help and guidance you need, whatever your situation. Alternatively, you can learn more about company insolvency and how to determine whether your business is currently insolvent by clicking on the video link here.